and you've gone through this cycle many times. Now, ultimately, businesses have to generate an economic value add, otherwise they shouldn't exist. What I have found strange this time around is that every company that we have seen has ultimately got funded, and that I find a much more scary proposition. I also think there will be a consolidation in my industry, a pretty significant one, because I think a lot of money has been invested, I think, in, I would only call it over exuberance. I think that has been error in judgment that I would accuse a lot of boards of a lot of these companies which went public too early, and I think the markets are a little too kind with all of them.
Hello everyone, welcome back to the show. I'm extremely delighted to host my former boss Rahul Bhasin to the show today. Rahul is the managing partner of Baring Private Equity India. Baring was one of the first few firms to introduce private equity in India in 1998. Before Baring, Rahul worked with Citibank across their global offices. Rahul is a graduate from SRCC and then did his MBA from IIM Ahmedabad. Welcome to the show, Rahul.
Thanks, Sid.
I know this would be a very insightful conversation. So Rahul, in this conversation, like in this show, we start with covering the journey of our guest. So want to know about what was your journey like from your early days to SRCC, then to IIM, then to Citibank.
So actually my interest in investing actually started because of something very personal. My paternal grandfather, who I was very close to, passed away when I was about 8.5 or 9 years old, and he left for me few shares in a company called Brook Bond. And it was because I was so close to him that I was very fascinated that if he has left something for me, it must be something important. So I wanted to understand what an equity share was. I had no idea. I was 9 years old at that time. And so I started asking questions from everybody that what is an equity share? What does this mean? What is this piece of paper? And I didn't stop till I understood what the balance sheet of a business was, how the capital was divided, what the equity share meant. And then I was very curious as to what this company called Brook Bond was. So I think I visited Brook Bond. I mean, I was living in Calcutta. The headquarters of this company, Brook Bond, was also in Calcutta. So I think the first time I visited their office was when I was 10. Yeah. And I asked them all kinds of absurd questions. I am astonished that I was not thrown out. But they were, I think, just amused with me. So they answered my questions. And I think by the time I was 12 or 13, I actually, started tracking lots of other companies also. And I remember that when I was about 14, I told my father that I know more about the equity markets than he does, and he should, let me manage his portfolio, which he was very amused with. So he told me that you do shadow investing, and if I can prove that I can produce better results, then he will entrust me with some money. He said, you do it for 5 years and show me. But at the end of 1 year, he seemed to have changed his mind. So when I was 15, he handed me 10,000 rupees and said, do what you want. And at that time, 10,000 rupees was a lot of money. It was not a small sum of money. And I just got very lucky in the first few investments that I made. I made a lot of returns. And in those days also, I didn't understand any risk management. So I used to take positions very large compared to the size of the capital I had. But I was just very lucky that I just, got things right a lot. It was also much easier time in the world to make money. And I got, and one of the sort of techniques that I figured out very quickly was results used to be declared annually. So shares used to stay static throughout the year, and then usually about a week before the results were to be declared, there was some trading in that equity, and there used to be, and it used to trade maybe for another week or 10 days after that, and then it used to stay at that level for a year. And since I was in Calcutta, I realized that, the big companies which used to trade there were the tea companies. So I figured out that all I need to do is to track where the auction prices of tea were, and I would know where the tea companies are going to do.
Correct.
And so that helped me considerably. And then very quickly I learned that I could do the same thing with steel, and I could do that with other commodities. And that became my sort of go-to strategy, that you just track the underlying price of the output and see how that is moving, and that typically you can predict the direction of the profitability.
Correct.
And that was a good way to invest money, and that was where it started for me. And then, one develops sort of more insights and more these things in the market. And by the time I was in college, I think I was a very frequent equity trader, and I wouldn't call myself an investor right then. It took me a while to transition from a trader to an investor, and a lot of reading, and I was just very lucky. I think very early in my life I discovered Warren Buffett's annual letters, which I think was a transformational education for me. And yeah, so I was very clear, and even during my MBA days, I used to sit in the library, and the library was air conditioned. It was the only part of the, and I read all the finance books, regardless of what was in the course or not.
Correct.
And I kept on investing. So by the time I actually started work, I had considerable experience in making investments, and and the flip side is that my father ran a small business, and I was also like his. I think the only correct way to describe my role was I was his mundu. I would do his procurement for him. I would write his accounts books for him. I would do dispatches for him. I would do basically all parts of all the execution work I would do, right, when he started out. And I think that also gave me a good insight on business. When you could make margins, when those margins would sustain, when they wouldn't, what the reasons were. And I think one develops an innate sense of curiosity around these things. And that, I think the two things played into each other.
You joined Citibank after your graduation, and you were telling me that you were the one only who was selected in the Treasury department of Citibank. Tell us about that. How did you get it?
Yeah, I think there were the Treasury department, Citibank in those days was a very small unit, but it used to make more than 100% of the profits of the bank at that point in time. But it was just my experience with markets, equity. I think when they interviewed me, they realized that this guy actually knows all of these things. Right. So I think that was quite, I guess, when you're that age, you're also a little cocky. So I think they sort of gave me one stress interview. But again, it was a subject that I was so familiar with that it was quite sort of... and when I started my career, again, I was very lucky to have really fabulous bosses who not only entrusted me, but they gave me limits across multiple asset classes. And by looking at multiple asset classes at the same time, I was able to triangulate one asset class with another. And I think that helped considerably. They also sent me off to Japan very early in my career. In the first year that I joined, they sent me to Japan for a while. Almost a year I was in Japan, and I think that gave me an exposure to the developed markets also. So you juxtapose the emerging market experience with the developed markets, and with all instruments like derivatives, etc. Very, if you look at the context today, I was exposed to these things very, very early. And that helped considerably. And, you could make in those days arbitrage profits, which resulted in my getting promoted very, very quickly in my career. So I had P&L responsibility at an early age. And again, if you get P&L responsibility, you're figuring out, the dynamics of running a business becomes that much easier in that sense. But there is tremendous amount of luck which has gone into all this, because at any point in time, my understanding and knowledge was quite poor. And I could have made a really stupid mistake, and I could have just got burnt. It's just a lot of good fortune that didn't happen, right? When I think of a lot of the things that I did from a risk management framework or perspective today, I think that, I took insane risks. Right? I was just very, very lucky that they paid off.
Talking about bosses, you also worked under Aditya Puri, who has built one of the most valuable bank in India, HDFC Bank. So how do you reflect back on that phase working with him?
I never actually worked for him on a day-to-day basis. He was part of the team that recruited me. But what I found fascinating is that you had to go to him for decisions on credit decisions, etc. Even for the Treasury beyond a certain size, you had to go to him. What I found fascinating about him is that his ability, he would ask for whatever information he wanted, and then he would literally say, "You give me 10 minutes." And he sat in a glass cabin, and you could see he would do nothing. He would not pick up a piece of paper. He would just sit there for 10 minutes. At the end of 10 minutes, he would call you back with a yes or a no. He wouldn't postpone any decision. He would take a decision on the spot after considering, whatever he thought was important. And the clarity of thought was something which was remarkable. The other thing about Aditya Puri, which I remember very well, was that in our induction, he looked at us and said, "You guys are from IIM, you think you are very clever." He says, "We have very low expectations from you. You guys are brilliant fellows. Don't have much expectations." His expectation was very simple, that he expected a 10% growth, right? Every month. He said that, if you can't even do that much, then what's the point of my coming to IIM Ahmedabad and recruiting? Yeah. So that's all that's nothing complicated. I just want 10%. That's all. So yet he set very simple targets, but they were demanding.
Correct. So what made you shift then from Citibank to private equity?
Actually, again, that's serendipity. I had Citibank was very good to me. I think very good to me too early, and I think they gave me a lot of responsibility, but they also then very generously rewarded me. And I had certain financial aspirations for myself, and I had met all of those. And I thought that I can live the rest of my life. And my wife was working, and we used to live in different continents at that point in time, and we had a baby daughter. And I agreed with her that I would retire from my job and look after the baby daughter. So I came back to India with the goal of retiring, actually. It seems a little absurd because I was 31 years old at that point in time, but when I did my financial math, I thought that this is fine. I think I didn't realize that my personality type is such that I think that was just extremely stupid. But just when I was trying to hand over my responsibilities, amongst my responsibilities was I was covering a lot of Latin America. I was sitting on a flight along with the global managing partner of Bearings, and he asked me what you're doing. So I said, I'm handing over responsibilities because I'm retiring. He thought it was absurd that someone my age would be retiring. So he said that I am very keen on India. We have a sort of office that I've set up in India for 3-4 years. We've never done anything. Why don't you supervise that for like an hour a day or 2 hours a day? And I thought that maybe in retirement also I need something to do. So I said, 1 or 2 hours a day, fine, I will take that up. And he said, okay, you be the managing partner, but you don't have to work more than an hour or two a day. So that was the deal I did. That's how I got into private equity. But within a week of starting, I realized that I cannot work 1 or 2 hours a day, and I just got sucked in full time. But there was no design to get into private equity. It was just pure accident.
Got it. So talking about private equity, if you can tell viewers about what private equity is, how does it work, and how it has evolved over the years in India now.
So I think private equity actually is a very wide term, and it's like saying manufacturing. Private equity is as broad a term, and I think that maybe I should explain the historical context of where it started and how it has evolved and different features of that. So this is a business which really started in America around the early 1980s. And what everybody forgets is that in the early 1980s, in 1979, Paul Volcker had raised interest rates in the US significantly till such time that the interest rates in the US, short-term interest rates, had reached 21% per annum. Right? So anyone who was highly levered was dead, and most people had cleaned up their balance sheets and raised equity. And so private equity started out basically because people had gone to the other extreme in terms of having their entire business funded only by equity. The entire model was that the capital structure is inefficient. You can have some amount of debt, right? Because if the minute you made a call that 21% is peak interest rates and they're likely to decline, and putting on some debt as interest rates decline, your ability to service that debt increased,
Correct.
and the equity value would rise much faster because it was levered at that point in time. And that's been the game really. You had a secular decline in interest rates where you could keep on increasing the amount of leverage you put on a balance sheet, right? And when 2008 global financial crisis hit, the leverage ratios had reached a point where it was something like 6 parts debt, 1 part equity. That was kind of the model which was being used, which was fabulous when interest rates kept declining. And after the global financial crisis, again, the central banks monetized the economy, so they kept interest rates artificially low. So this sustained, right? And so it's been a game of putting on leverage. And when you put on leverage, then your debt capacity goes up if you can squeeze costs. So a lot has been about rationalization and about squeezing costs. But this is what has happened. This is the game that has been played in the developed markets, right? And people have made extraordinary returns, but if you hold a levered asset class and interest rates decline from 21% per annum to 0 over an extended period of time, and you're putting on more and more leverage, the returns you earn are really fabulous, right? Because you also got PE expansion because the cost of capital was declining. However, in India, in all emerging markets, there was none of this opportunity set. In India and in emerging markets, the opportunity is really about growth and where growth comes from. And it's about businesses which have the ability to grow fast. And it's about partnering with entrepreneurs who are solving a real problem and helping them in terms of sustained growth. Facilitation of sustained growth, right? So if I look at our own portfolio, if I do a mapping of our IRR over 25 years, and I do a mapping of the underlying growth of the portfolio companies in terms of revenue, they both are 30% a year for the last 25 years, right? It's an identical match. Now, if in an Indian environment, if you look at it, have we had margin expansion also? Yes, we've had margin expansion. We've had asset turns improving, but we have also suffered from PE compression right across our portfolio. Almost that has been a universal phenomenon, which means we have always bought at a higher multiple and sold at a lower multiple, and the margin expansion and the asset turn, improvement and the cash cycle shortening has compensated for the PE compression that we've had, and what we've been left with in terms of returns has been the top line growth. And so it is a very different business. It's not about leverage. It's about how to facilitate and accelerate growth. And growth has its own challenges and has its own, largely because, if a company were to grow, say, 35% a year, which, a lot of young companies grow very easily, in 2 years you've doubled the size of the business, right? So the systems you need, the processes you need, the Peter Principle kind of problems you need, because everyone doesn't keep up with that growth. How do you break up their jobs? How do you train people? How do you anticipate these problems and prevent them from happening? Because otherwise the company will just hit a sort of wall at some point in time. Those are the harder challenges. The other thing is that how do you develop a sustainable competitive moat so that somebody being a Me Too and copying you, how do you prevent them from eroding your margins, right? Especially in a hot sector where everyone wants to jump in. I think these kinds of issues are what we tackle with and what we work with, right? A lot of times it's about attracting talent and sort of making it a sort of good place for talented people to find it attractive to apply to, join, work in, be empowered, incented, and the ability to have a sort of way in which they can actually contribute in a positive environment, right? And then there is the entire bit of efficiency, productivity, a lot of training interventions, and how to drive experience curve, how to determine what your competitive advantage is, make sure that the organization design is focused that way, reinforcing all the things which actually deliver you your competitive advantage, incenting that, reaffirming that kind of behavior so that in your marketplace you can actually deliver and retain that kind of edge.
Yeah.
And then comes the growth journey, which is like a lot of it is about having a more in-depth understanding of your existing customer set, selling what you're selling to existing customer set to newer customers, often it means newer geographies, selling new things to your existing customers. And often in a market like India, it's about stripping down a product or a service to its core value proposition, lowering the price so that you can address a wider market, right? I mean, these are the basic constructs and basic strategies, but that's what typically our role is. One of the big challenges that I have found in India, and in fact in most other emerging markets also, is that because capital is so scarce, most entrepreneurs very often when it comes to growth, they sort of try to get a right to play. They don't sort of focus on a right to win.
Right.
So they will often say that, okay, I want to try the German market. Let me put one person there and try, right? Whereas that will always fail. But what people will not do is to put a full-fledged team there, put accreditation, spend money on marketing, spend money on PR, give free trials to people. So they don't go the whole hog, which enable them to succeed. But I guess this is just an example of the kind of mistakes we see very often, and then when we are working with the company, we can prevent those kinds of things. So it's all about growth facilitation at the end of the day in our business.
Got it.
There is, of course, this entire idea of where can you grow, because if you grow by taking away market share, typically you have to trade off on margins. So you want to find disruptive parts of the economy which are likely to grow much faster and are underserved, because growing into that ecosystem allows you to grow and retain margins, and that's where the highest value creation typically takes place.
So Rahul, the concept of savings and investments has taken a big shift in India. Now the funds are flowing, people are more towards investing in public equities rather than they were earlier investing in savings and fixed deposits. And this can be highlighted by the growth of demat accounts in India, which were around 4 crore in March 2020, and in last 2 years now it's like 10 crores mark they've crossed. And there's no structured understanding about investing in any younger generation. So if you have to suggest someone like me, younger generation who just entered into job field or anything, they've started earning money, where should they invest their money?
So I think it's important to step back, look at the world context, and then I'll answer in that context. Right? You have a situation where most of the developed world has got debt, which is extraordinarily high. And if you look at it, the world as a whole, global debt to global GDP is over 300% now. And there is plenty of evidence to say that that is completely unsustainable. And typically when debt levels are that high, there is always a lot of defaults. Now this debt is largely in the hands of governments, right? How do governments default? Now historically, many times governments, if you look at history, many times government have said, sorry, we owe you this much money, we're not going to pay you. But in those scenarios, democracies didn't exist.
Yeah.
A democratically elected leader will seldom say that, because that basically means he'll never get elected again, right? So the way they actually lower the real value of the debt is to inflate away the real value of the debt. How will they do that? They will keep changing the way in which inflation is measured. They will always say inflation is transitory, transient, temporary, and they will basically keep sort of making inflation sound much less than it actually is, right? But they will keep reducing the real value of the debt, because that's the only way the equations will work.
Yeah.
So if you are in that kind of global environment, right, India is not so bad actually relative to lots of the developed world. But in that environment, typically, if you are in cash or you are in debt, you will almost surely systematically lose purchasing power. On top of that, if you look at the taxation architecture, if you get interest, etc., you are paying tax at the highest marginal tax rate, right? Whereas if you convert it into capital gains, you have a an arbitrage there in terms of taxation. So almost certainly for a young person, I would advise almost an allocation, other than for what money they need over the next 6 months or 12 months to live on, in terms of, or for their emergencies, I would expect basically they should go 100% into equities. But it's wrong to go 100% into equities at one go, right? Especially when you don't understand equities well. I would smoothen my inflow into equities. So I would basically say if I have these deposits or cash, I would take 3 years or 4 years and systematically put that excess amount of liquidity that I have into equities. And in the future, whenever I get additional liquidity, I just invest it into equities. But I keep on doing it systematically, so this volatility of markets going up, markets going down, you become immune to, and you will end up generating a much higher return. The only other suggestion I would make is that if they look at businesses which have a return on capital employed which is more than their weighted average cost of capital of that business, or if they don't understand that and they're not familiar with the financial world, just look at a return on capital employed of businesses over 15% and invest in those, right? But invest systematically and get 100% into equity. That would be my advice. And if you want to keep fixed income kind of instrumentality, I would invest in REITs, real estate investment trusts, for some small portion of my, right? As a person who is retired or retiring, etc., up to a certain point, right? Maybe they should have a higher proportion in REITs, right? I would not keep money in banks and banks deposits. And beyond that certain minimum level, or the next 2 years or 3 years of cash flow, I would still stick to equity. I've personally never been less than 100% in equity as an investor, not since the age of 14 for sure.
So also, Rahul, you don't invest in real estate. So that's also true.
Yeah, I've never invested in real estate, that's correct. Real estate will never generate, an economic franchise which is generating a return on capital employed, has an opportunity to reinvest that capital, service newer and more customers, will always generate higher returns for you than real estate will. Right? And if you have the ability to identify those franchises properly, of course with the overlay of having good governance architecture on them, then that will always seriously outperform any kind of real estate investment over any long period of time. Right? Also, real estate investments, normally, even if people don't understand anything about investing, it's still, in an inflationary environment, it's typically a safe place to invest money. So they know that you're getting inflation protection typically. But if you have some idea of how businesses operates, how the corporate sector operates, and which sectors are likely to grow, and you have a systematic investment plan, you will do much better in equities than real estate ever.
Yeah, correct. Covering about investment. So what has been your best investments for bearing or even your personal investments?
It's very hard to pick one or the other, but lot of times the best investments have been pure serendipity. Right? I think I remember when I started my career, I borrowed 10,000 rupees to invest in what's now Oracle Financial, and I made several thousand times my money on that. But borrowing 10,000 rupees in those days was a bit extreme, but I had huge conviction around it. I remember that I think in late 1997, I'd just come back to India from London, and I remember that everybody was saying that Marico would go under because I think the Levers chairman, I think at that time it was Dadi Seth, had said that they would just take over the coconut oil market and they would kill Marico. And the multiples in Marico went down to I think 5 or 6 times earnings. And I thought it was absurd that a business which had a 40 times asset turn, people could think that it will go under, because all of Marico's return on capital employed was coming from how quickly they turned their money, not from a high margin, right? So I thought it was completely absurd. Again, I borrowed money and I bought a huge stake in Marico, which is worth, several hundred times what I put in at that point in time. These are, I think, more on the personal side. I remember also buying into a company which is, Vardhaman Textiles. There was a point in time when the company was, the consensus was that the company would go bankrupt. And I just felt that people are not going to stop wearing clothes, and they were the most efficient producer of cotton yarn in the country. And I said, there's no way that this can happen. And I remember I bought into that company at 1.5 times cash flows. And I have held it forever. But and when I spoke to the management, a friend of mine was there. He told me, Rahul, I've been recommending this stock to everybody, but it keeps going down. And he says, most people have recommended to stop talking to me. So, please don't buy it, because if it goes down further, you'll stop talking to me. So I said, I didn't ask for your advice, and whether I buy it or this thing, I don't need to talk to you. I have my own judgment, and I bought the shares, and it's done spectacularly well for me since, right? Professionally, I think bets that one took, and I think there's a lot of serendipity around it. There was a company called Baran Energy in the ex-Soviet Russia and the Caspian region, where we had funded them several times, and they needed small amount of incremental check, and we really thought about it, and I kind of pushed that no, we must do this. We were really lucky, because they just, with that little bit of incremental money, they found a lot of gas fields, and we made billions of returns on that, right? I mean, that's in India, I guess some of the tech, making bets in some of the tech sectors, and I think even loss-making companies, which we then turned around ourselves. I think those have been quite spectacular for us. But I think we've also encountered many phenomenal sort of entrepreneurs, and I think that the cultural shift where now, I would say hardworking, qualified people who are ready to jump into entrepreneurship, the quality of entrepreneurs that one comes across. I am more excited about our business in the last 3-4 years than I've ever been, especially in India. I think it's just magical. I've had the opportunity to work around the world. I haven't seen this kind of entrepreneurial energy in any country ever. So it's quite spectacular in that sense. So it's, I think that this kind of energy is going to transform this country very significantly.
Right. So also, Rahul, this so-called now funding winter in India specifically, across the globe, what has sparked this kind of change? Like 6 months, everybody was getting funded. Now suddenly the talks has changed from growth to profitability.
Look, like everything goes through cycles, right? And you've gone through this cycle many times. Now, ultimately, businesses have to generate an economic value add, otherwise they shouldn't exist. So the fact that profitability has come back into fashion, it was inevitable. It has to, right? There is no harm in business losing money, as long as there is a concrete plan as to why they're losing money, what is the moats that they're creating, what is the value proposition they're creating, so that they can generate an economic value add and an economic surplus over any, over a sustained period of time. If that were not the case, right? Saying that I will one day figure out how to make money, I think is, that's not investing, that's gambling.
Yeah.
Right? And to my mind, a lot of times you've had cycles where things get overvalued and people, fund companies which are not making money because that's the hype cycle. But that has been, that's how technology works, right? Because new things come in, people get very excited about it. But technology investments typically work there are two segments to it. There's typically what's called an installation phase and there's a deployment phase. The hype is highest in the installation phase, but companies never make money. They make money when the deployment happens, when use cases get transcribed, when customers start adopting it. And typically by that time you've had an entire cycle of people putting in lots of money, getting burnt, dying, and that's when the party really starts. I mean, if you look at the 2000-2001 tech bubble, right? A lot of those businesses actually had tremendous potential. But they started making money, they started thinking of real economic plans only after that crash happened.
Okay.
Right? So you will see something similar. In India, what I have found a little strange in this time around is not the fact that people were overpaying for a lot of businesses. In fact, I think on the margin they still are for good businesses. But typically if you overpay for a good business, the growth will, forgive all your sins. But what I have found strange this time around is that every company that we have seen has ultimately got funded, and that I find a much more scary proposition, because if I look at a 35-year kind of prism that I've seen, typically only 4 to 5% of companies typically, across cycles get funded. I mean, when there's a excessive bull market, then that number is much, much more. And in bear market that number is smaller, but I have never seen a scenario where every single company which is out there to raise capital has raised money. So I think it has put an extraordinary strain on the talent markets in India, and you will see a big correction there too when this pans out, not just in valuations. I also think there will be a consolidation in my industry, a pretty significant one, because I think a lot of money has been invested, I think, I would only call it over exuberance.
Also, there are times when we like a particular company, but the price which it's trading at is not the right value. It's not the correct value. And we've seen, because we were talking when a lot of tech IPOs were launched in India and they were priced like overvalued by high different margins. How should anyone think about that? Because in this market, the market which happened, tech IPOs, everybody got invested and lost money. What will you say to that generation which should not go into that hype whenever it's created?
See, most things you can fix in a business if you're involved with it, except overpaying at the start. Right? But I think that a lot of the companies which went IPO, I think they had a deeper problem. I think the problem with a lot of these companies were that they had a certain market which they could cater to today, which had the economic purchasing power to actually buy that product or service. But all of them, in their exuberance to show high growth, started acquiring customers who did not have the economic wherewithal to actually pay for the product or service. So what these companies were doing is they were subsidizing the acquisition of those customers. Now, if you grow into customers who can pay for what you're delivering, you create a valuable franchise. If you keep acquiring customers who you have to subsidize not once, but over several years, in the hope that one day their sort of, economic surplus will reach a point that they can actually afford to pay for your product, then to my mind, you're often detracting from the value of your business. I think that has been error in judgment that I would accuse a lot of boards of a lot of these companies which went public too early, and I think the markets are a little too kind with all of them.
Yeah, right. Market teaches everyone.
Inevitably.
Also, young investors like me, I've seen a lot of my friends get enticed by making quick money, and because of that they've invested in a lot of new types of asset classes, maybe cryptos, different coins and all, and they've lost money. How does your experience, because you have been in different cycles, you have seen ups and downs, what will you tell them or recommend them?
If you don't understand something, you're not investing, you're gambling. And if you're gambling, Set aside 1% of your capital for your entertainment and your gambling, but leave 99% of your capital in areas which you understand and where you can park your money safely. And if like I said, follow the rule. If the company doesn't generate at least a 15% return on capital employed on average for the last 5 or 10 years, do not invest in that business.
Coming on these parts, I just want to know your views on these newer terms which comes up now. Crypto is one, then there's the technology which it works on blockchain, the Web3. How are you looking at these things now?
A lot of the enabling technology of blockchain and this distributed ledger and the architecture around it is fundamental. Right? And it has lots of applications. But the way in which it is being used today and the energy costs associated with the mining of the blockchain and the is basically unviable except in very specialized, high value, low frequency transactions. Right? And I know people like Ethereum, etc., are trying to develop technologies and compression technologies where you end up using much lower energy ultimately. But till such things that those are actually installed and you can deploy and you can create commercial use cases, I think that the economic payoff for all of this, I mean, is there a technology, genuine technology, transformational technology? There is. But is there an economic model which supports investing in it on the scale and the values that are happening today? I really don't think so. Okay. Right? Web 3.0, distributed organizations, etc., have use cases. They're very specialized use cases, and I think they're fabulous for a bunch of musicians who come together in different parts of the world, create some music, and they can share the royalty. And these kinds of use cases are there, right? And there will be more, but they have not been. You could have also open contracts, and these kinds of use cases will develop. It will come about, but there is an entire adoption cycle, etc. And I think that the markets are discounting the present value of that a little too aggressively.
Okay. So last question for this set of part. How was Rahul in his young years and how you're working right now? And there's been a lot of debate about, recently someone posted on LinkedIn that young persons in the when they just join job, they should work 18 hours a day. What's your take on that?
I think that you should, when you're young or old, you should do something which you really are passionate about and you enjoy. Then you won't register how many hours a day you're working. Right? If you're passionate about something and you put in an effort, you'll be good at it. Right? And if you're good at something and you're passionate about something, you won't worry about how many hours are going by one way or the other. And so I think if you need to count the hours, you probably need to check as to what you're doing and whether that's really something for you.
That's the perfect answer for this. Okay, so Rahul, now we'll move to the lightning round. I'll just ask questions and you just have to answer questions fast. That's
sure.
I'll start with light questions. What's your favorite restaurant? Now and before also, now because you're vegan, but what's your favorite restaurants? Delhi or
in Delhi, I can tell you that it's a restaurant called Mala Akbari, which gives historical Indian cuisines, fantastic ambience, fantastic service, and fabulous food. In Bombay, I would say it's Burma.
Yeah. Next question: which Indian startup excite you?
It's very tough to name one, but
or the sector.
I think Videoverse, where you're working currently, is a fabulous company. So is Satshaw, so is Loham. I think the list is quite long. It's just I love the entrepreneurial energy. I love the way in which people are harnessing new technologies to deliver goods and services today, and I love the way that this mindset that in India we can only copy and we can't be ahead of the curve. I love the way that has changed, and I think that is the most fabulous thing, that Indian companies today have the confidence to get out and say, I will make the best product in the world and I will capture the global markets. And I think that to me is really fulfilling and exciting at the same time.
So what startup product or services you use every day?
Well, I just ordered some food on Zomato, so that should answer your question.
Yeah. 3 book recommendations to the younger generation.
I would read The Warren Buffett Way by Hagstorm. I would read something called. I would read Charlie's Almanac. I would read. Generally, I think to understand businesses, I would read one of Porter's books on either competitive strategy or competitive advantage. I would read one of those books.
One regret in life.
That's a very tough one. I really need to think about that. But I guess I lost my parents many years ago. I wish I'd found ways to spend more time with them while they were around, and that's something that I regret.
Last question. What is success for you?
Success to me is to wake up with a smile on my face and do what I want the whole day, and come back in the evening with a smile on my face. That's a success for me.
That's perfect. So that's it. Thank you so much, Rahul, for being on the show. I think it's a lot of insights has come through. I think I'll also go and watch it again and again to get to download all the things. But thank you so much.
Thanks, Sid. Thank you.